Most people think that finding a stock under $20 is the easiest way to make a quick fortune. They assume that a low share price automatically means a company is cheap and has room to explode. The reality is that a single share of a company can cost $5, but still be incredibly expensive based on its actual valuation. If a company has massive debt, shrinking revenue, and no path to profitability, that $5 stock is likely headed straight to zero. True wealth in the stock market isn't built by chasing low share prices blindly, but by finding high-quality businesses that the broader market has completely mispriced. Today, we are looking at companies with massive hidden potential, surging revenue growth, and specific catalysts that could trigger a massive breakout this year. If you know exactly how to spot these hidden gems before the institutional money floods in, your portfolio could look completely different 12 months from now. What most people do not realize is that the entire small-cap stock market has just experienced its strongest start to a year since 1991. The Russell 2000 index actually outperformed the major S&P 500 index by more than 12 percentage points over the first half of this year. This massive shift tells us that the smart money is aggressively moving out of overvalued tech giants and rotating heavily into smaller, nimbler companies. The first stock everyone should consider as a cornerstone for this strategy is a massive household name that has been severely beaten down, Intel Corporation. While advanced chip competitors have taken the spotlight over the last year, Intel has been quietly staging a massive structural turnaround. They still control a massive 60% market share in the global PC processor market. More importantly, they are receiving billions of dollars in government subsidies through the CHIPS Act to build the premium Western manufacturing foundries of the future. The stock is trading at a historic discount compared to its long-term intrinsic value. Wall Street analysts have already begun aggressively raising their forward-rolling 12-month earnings estimates for the company by double digits. The surprising part comes next, because the real exponential gains do not usually come from the mega caps everyone talks about. The true multi-bagger opportunities are hidden in under-the-radar companies that are solving massive global infrastructure problems behind the scenes. Think about the explosive growth of the digital economy, automated transit, and public transportation networks. A prime example of a stock most people have never heard of is Via Transportation. This specialized technology company builds complex software solutions for dynamic on-demand public transit systems globally. While traditional tech valuations are stretched thin, this company is flying completely under the radar with a massive 49% discount to its estimated fair value. Their brand new artificial intelligence platform, the Scheduling and Supply Studio, is helping city transit agencies optimize their entire fleets under tight budget constraints. Because of this, their first quarter sales skyrocketed from $99 million last year to a staggering $127 million. Wall Street projections indicate their core platform revenue is on track to hit an incredible $550 million by the end of this year. Before you skip to the end of this list to buy shares, you need to understand the exact metric that separates a true winner from a dangerous value trap. You should always look for deep insider buying actions, which happens when corporate executives use their own personal money to purchase shares of their own company on the open market. If you want to see exactly how these market dynamics and technical indicators play out in real time, hit that subscribe button right now to stay updated on our daily financial breakdowns. Corporate insiders might sell their stock for 100 different personal reasons, but they only buy for one single reason. They know the current stock price is far too cheap and is about to go up. Another incredible example of a hidden growth powerhouse experiencing massive insider buying right now is a unique company called Betterware de Mexico. This company dominates the direct-to-consumer product space, but the broader market treats it like a boring legacy retailer. What Wall Street is completely missing is that the stock currently trades at a massive 44% discount to its true fair value. It possesses a highly attractive price-to-earnings ratio of just 10 times, which is incredibly low for a company expanding its digital footprint so rapidly. When you combine an incredibly low valuation with strong consumer demand and executive teams aggressively buying up their own stock, you get the perfect recipe for a massive short squeeze and a long-term upward re-rating. What most investors do not know is how to spot these exact macro trends before they hit the evening news. The massive small-cap rally we are witnessing this year has been heavily driven by speculative sectors like quantum computing, biotechnology, and clean nuclear energy. If you want to capture the absolute highest potential upside, you have to look at the specialized suppliers fueling these capital-intensive industries. Look at companies like Nu Holdings, commonly known as Nubank, which is completely revolutionizing the digital banking and fintech space across Latin America. It is currently trading at a steep 41% discount to its long-term fair value rating. The company is consistently pulling in millions of new active customers every single quarter while maintaining microscopic operating costs compared to traditional legacy banks. This combination allows their net profit margins to expand exponentially. When a company grows its top-line revenue at over 40% a year while trading at a bargain valuation, it is only a matter of time before large institutional mutual funds notice and force the share price violently upward. To build a highly successful portfolio, you must balance these aggressive, high-flying tech names with deeply discounted, cash-generating industrial businesses. A great final example is the global automotive giant, Ford Motor Company. The market has heavily punished the stock due to the massive capital expenditures required to scale their electric vehicle divisions. What investors are forgetting is that Ford's core commercial vehicle and service division, Ford Pro, is highly profitable and generates massive recurring revenue streams. Their iconic F-Series trucks have remained the best-selling vehicles in America for over 40 consecutive years. This gives the company an incredible cash cushion to fund its future growth while trading at a valuation that prices the business as if it were going out of style. The critical secret to making life-changing returns in these specific positions is keeping a very close eye on what is happening in the markets every single day. If you want to see exactly how these specific stock picks reacted to the massive economic data releases that dropped earlier today, make sure to watch our next video. We will break down the exact execution strategies you need to master. Stay safe, and I will see you on the next video.